Beautiful. Everyone can see my screen. Okay, perfect. So, hello, my name is Jennifer Duran. I'm a program associate here at the Office of Economic Empowerment, and welcome to our Worth and Wealth webinar. Today's topic is smart saving strategies for every life stage. Before we move on, just want to give everyone a reminder about the disclaimer that this webinar is being recorded. If you would like more details, check out the message in the chat. And as always, all materials, including the recording, the slides you'll be seeing from our presenter today, and any supporting documents will be available in a follow-up email to everyone who registers. So even if you can't attend, we always encourage everyone to register for the webinars. You'll receive everything. And without further ado, I'll introduce our presenter for today, Samantha Morales. Samantha Morales is a financial advisor and financial coach with over 20 years of experience in the financial services industry. I'm super passionate about helping people get their finances together, so much so that she started a nonprofit called Ahora Inc., where she helps low-income individuals and supports them in their financial wellness journey. And I will let her introduce herself. Thank you, Samantha, for being with us today.
Thank you so much, Jennifer, for the kind introduction. And I want to thank everyone for joining us in this rainy day and for taking time out of your busy day to share this hour with us as we talk about smart saving strategy for every life stage in our lives. So this is built upon the last couple of presentations that we've had when we talked about, okay, what's generational wealth and why generational wealth is important. How do we budget and how do we maximize our income while minimizing our expenses? So now I'm going to talk about, okay, what are the smart strategies that we can use to save toward goals and to achieve anything that we want to accomplish at every stage of our life. So as Jennifer said, I am Samantha Morales. I'm a financial coach, financial advisor, founder also of a financial planning firm and the nonprofit Ahora, which is dedicated to empower individuals with financial literacy and coaching. I'm also proud to say that I'm the chair of the Board of Trustees at Salem State University. I am very passionate about empowering the next generation of leaders in Massachusetts. So being part of Salem State University gives me that opportunity. And my mission is to provide clarity, confidence, and control over people's finances. On a personal note, I enjoy walking. I enjoy going to the beach. I enjoy learning something new every day. I enjoy exploring new places, restaurants, or farms, or museums with my husband and kids. And then I put a picture of my happy place. My happy place is by the beach, nice sunny day, warm days, drinking a freshly made lemonade. So that would be my happy place. So that's what I'm thinking about in this rainy day. All right, so let's get started. So before I get into the webinar, I do want to provide a disclaimer that any information that I'm presenting in this webinar is educational and informational. It does not constitute any financial, legal, or tax advice, and any example that I'm providing is hypothetical and for illustration only. So please, if you need to make any financial decision specifically for your situation, you can consult a qualified financial professional, or you can schedule a one-on-one coaching session with me, and then we can go into any specific details related to your specific needs and challenges. All right, my goal for today is for us to understand the difference between emergency, short-term, and long-term savings. They all have a different purpose, they all have a different strategy, and they all serve at different times of your life. We'll learn what the basics of a 401k, an IRA, and a Roth IRA account. And also we'll talk about how do we identify simple ways to begin saving for those of us that have children. Or it maybe if you're a grandparent, you can also utilize these strategies to save for any grandchildren or any family members in your family that are either college age or younger. So if you have any questions throughout the presentation, or if you want me to clarify on any particular topic or aspects of the presentation, put it in the chat and Jennifer will monitor anything that is populated in there, and then I can stop along the way and answer any questions and clarify any points during my presentation. Okay. Okay, so now let's start very basics. What are the types of savings? One, I'm sure you've heard an emergency fund. An emergency fund is intended to provide a safety net. An emergency fund is for those unexpected expenses that may come up throughout our lives. Our car broke down, or something health related happened, and now you need to go to the hospital or buy a very expensive medicine. So again, it's meant to be only for emergency purposes. You may have an emergency fund that is just sitting there for 3 years, and it's just sitting there as long as you need it. So if you don't have any emergency, then that's great. Just let it accumulate there. So when something comes up that is unexpected, at least you already have that saved. And it avoids us using credit card or having to ask for a personal loan or anything to help us get in debt. And then another type of saving is short term. And the short-term savings are for goals that are within 1 to 5 years. One of the examples could be, I want to go into I want to go to my dream vacation next year, or I want to buy a house in 3 years. So maybe in 5 years, I'm going to buy an investment property or open a business. So those are goals that are within 1 to 5 years. And then you have long-term goals that are 10 years or more, retirement, or maybe you have a property and maybe you want in 10 years buy another property, or another example could be buying a business or anything that may take you more than 10 years to accomplish or achieve that particular goal. And the reason why I want to differentiate these 3 types of savings is because each one of them will be deposited or invested in different accounts while they sit there. So the purpose is, how do we maximize the income that we have? So is growing interest, is growing revenue, or is growing dividends while we let it sit there? Okay, so true or false? Most Americans can cover $1,000 in emergency expenses without borrowing any kind of money or using credit cards. True or false? If you can put it in the chat. So Jennifer, maybe we'll wait a few seconds and see what the consensus is.
Okay.
Do most of us have $1,000 for any emergency? Yes.
Yes, we have 1 true and just about 4 false.
Okay. So whoever posted true, that is true. Most people do not have $1,000 in an emergency account to fund any kind of unexpected expenses without the need of using a credit card, or, hey, mom, dad, I need money. Hey, sister, brother, I need money. So it's not something that a lot of us are prepared. But again, that's just most of us, but some of us do have some saved up. So thank you for answering those questions. So if you are in the category that you do not have enough money, or you know someone that does not have enough money to save or fund any unexpected emergency, let's talk about that. Okay, how do we build that emergency fund? So after we go through the budget, I know how much my income is, I know how much money I have to pay for my essential expenses. So if you guys remember the last time we had the presentation, we talked about income, essential expenses, non-essential, and then savings. So the in order to understand how much you should have in your emergency fund, you need to also understand what your essential expenses are. How much do you need to pay for rent? How much do you need to pay for your card if you needed to go to work? So what are those essential expenses that you have that you need to cover with an emergency fund in case also something happens with your job, or you can't go to work for a few weeks and now you need to pay out of pocket? So starting to save for that emergency fund does not need to be a really a big goal. We can start with small amounts. And I would recommend starting with a $25 to $50 per paycheck. And you do that automatic transfer from your checking account or every time you get paid, and you put that in a savings account. So the more you do it, the more a rhythm it becomes. Then you can increase as you go, and as you're able to increase that dollar amount to now to $30, to $55, to $60. So providing an automation for savings is key. Where to keep it, because we're not using it right away. Hopefully you don't have an emergency where you have to use it right away. So if it's going to sit there for a period of time of months or maybe a couple of years, I will recommend saving toward what's called a high yield savings account. And we talked about that the last time we had the difference bank accounts. So the high yield savings account, it's an online savings account provided by only certain banks where you accumulate an interest. So it compounds. So let's say you deposit $100, next month you have $105 because you receive a $5 interest payment. The following month, you're going to earn interest on the $105, not the 105, the 100, not the 100, but the 105, because the interest is compounding. So and then the longer you let it sit there, the more interest you're accumulating. At least you know that as you wait to use the funds, you can at least accumulate interest in the high yield savings account. The interest rates in some of the vendors right now range from 3.5% to a couple offering 4% on interest. And then there's a money market fund. A money market fund is different than a bank account. A money market fund, it's something that you will buy to what's called a brokerage account. And we'll go into that a little bit more during our next seminar, which is a investing 101. And we'll go into more details of what a brokerage account is and how do you get one. But a money market fund is a fund that does not change in price. It's at $1, but it gives you a higher interest rate because it's considered an investment fund. And then tips for growing steadily. Let's say your paycheck is one option, but then if you have an employer where they offer a bonus once a year, twice a year, you can use that bonus toward your emergency fund. If you receive a tax refund, you can do a lump sum and savings deposit. Or if you have any side hustles where you're either selling things online or you are driving Amazon after work hours, any additional income that you make, you can put it toward your savings or investing. Okay, so that is a regular savings account. So now, so I do want to say that for that short-term goal, you can also put money in the high yield or in the money market fund. So that's not just for the emergency, it also could be for your short-term goals of 1 to 5 years. And if you have something more than 5 years before retirement, again, we'll go over those details next week. So any questions before I move on to the 401k option? Or anything that you want me to clarify? Okay.
Nothing so far. Yeah.
Okay, thank you, Jennifer. All right, so let's talk about the 401k. So again, you have your emergency fund for emergency purposes. It could be $1,000 to $2,000, depending also on your financial needs. So maybe you can have 1 month of rent, just in case. Maybe you can start there. If you're not sure, then I would just start with $500 to $1,000. But as long as you have something, you can go back to that. That's the idea. So now let's talk about more of a long term, and is for a retirement account. So a 401k is one of the options. So there's other options that nonprofits offer, or if you are a state employee, then there's other options that you have other than the 401k. But for this particular example, we're just going to talk about the 401k. A 401k is an employer sponsored retirement savings account. Some of the key features of a 401k is that you can make contributions either pre-tax or you can make them after tax. If you make them pre-tax, you can reduce what's called taxable income. And I'll give you an example of what that means. Number two, you can set up automatic contributions. You can tell your employer, I want to automate a transfer every paycheck of a percentage or an actual dollar amount. You can do $50 or you can do 1% or more, depending on how you want to set it up. Employers may also match that contribution, and it's free money. The reason why I included may is because not all employers offer a match contribution. If you're not sure if your employer offers a match contribution, you should definitely ask your HR representative and ask the specific question, do you provide any match contribution options? And it's basically free money. It's the employer saying, if you deposit, let's use 3% into the 401k, we'll match 3% of that, or 2%, depending on how the employer is setting it up. It varies from employer. So it's important that you ask your particular employer, if they offer a 401k, two, if they offer match contributions, and three, how much do they offer, up to what percentage. A key feature of a 401k is that you have higher annual limits to deposit in your 401k account. And we'll talk a little bit more what that means later. It also grows tax deferred until you retire, meaning you're not paying taxes until you reach retirement age and you start redeeming your funds. So you just deposit and it just grows there, tax deferred. You don't have to pay taxes until retirement age. I put here an example of what a 401k statement will look like. This will be either available through your employer HR website, or it can be available through what's called a custodian bank. A custodian bank is the actual bank that manages the 401k investment fund. It's not a regular bank like Eastern Bank. It's more like a Fidelity or a Vanguard or a Bank of New York. Those are custodian banks. They actually price and value the 401k retirement plan. So I don't know if you can see this, but let's start with this. So you'll have the name of the bank, the name of the retirement plan. If the plan has a code, you'll see it there. Some plans have a plan account number. You'll see that there. You'll see the period of the account summary. In this case is January 1st, 2024 to February 2nd, 2024. So this is a month, a monthly statement. You'll see the beginning balance and any withdrawals or any deposits or any transfers or any contributions that you've had. during that month. And then this earning is how much your $16,000 earned during the month of January. It will give you the ending balance and then what's called vested balance. So vesting balance means, so when you start a job, let's say I start working for company X tomorrow and I start contributing into the 401k. The company may have a policy that any money that the company is matching, it's only mine if I stay in the company for 3 years. So my vesting period is 3 years. If I leave the company before the 3 years, I am not allowed to take the what's called unvested balance. I can take the contributions that I made, but I cannot take the contributions that the employer made until the 3 years have passed. And then in here, you'll see what the rate of return is, basically how much your funds earned for the month of January. And then on the other side, you'll see, okay, you can see how much you have contributed to the fund. In this case, is $5,000. And then how much the employer has deposited or has matched in the fund. So you'll see two separate amounts. One, the ones that you contributed, and two, the ones that the employer has contributed. And then the investment activity is where your funds are deposited. So this is exactly where the fund is and how much those funds have earned during the month of January. And then your ending balance. But I wanted to show you because we don't really look at the statement, but it's important to look at it so you can see what your balance is, how much you're earning, and how much is employee match, employee contribution, and how much is the employer match. Any questions or any points of clarification that you want me to add?
No questions for now. Someone said that this is good to know that they were not familiar with that. So thank you.
Perfect, perfect. And as Jennifer said, you'll receive my slides at the end of the presentation, so you can go through it in more details at your own time. Okay, so remember at the beginning, a few slides ago, I said that you can contribute to a 401k pre-taxes or after taxes. So I want to walk through both scenarios. What if you do pre-tax, and then what if you do after tax? So this column here is if you make a pre-tax contribution into your 401k. Now 401ks have the options where you can do a pre-tax contribution and then an after tax. So let's say you make $60,000 a year and you contribute 10% of your salary before tax, and then that your employer matches 4% of what you contributed, and that is $2,400. Your annual contribution is $8,400. Your taxable income, meaning what you're reporting on your tax return, it's $54,000. Is the 60,000 minus the 6,000. Your employer match does not impact your taxable contribution. It only impacts your 401k balance. So you pay taxes on the 54,000. Now let's assume you have a 22% tax bracket. You pay $11,000, $880 at the end of the year. You take home pay, it's $42,120. Your investment growth tax deferred. You don't pay taxes on the 6,000 or on the 2,400 until you take the money out. On the other end, let's say you do want to do an after-tax contribution. Your annual salary is 60,000. You're still contributing the $6,000, which is a 10% contribution rate. Your employer is matching 4%. Your annual contribution is $8,400. Your taxable income is 60,000. It's not 54, it's 60, because you're paying taxes before you deposit money into your Roth 401k. You paying taxes now is $13,200. Your take-home pay is 40,800. Any growth in your 401k and your Roth 401k is tax-free. Basically, when you take the money out, you don't have to pay any taxes. The option that you take in here is that you're paying taxes now instead of later. And then one of the questions that you will ask, okay, Samantha, why would I want to pay taxes now rather than later? And that's a great question. So if you are in your 20s or if you are in your 30s and your income is $60,000, but you're expecting your income to go higher as you maybe have a promotion or maybe as you go to a different employment, let's say in 10 years now your salary is going to double. Well, as your salary increases, your tax bracket is going to increase. So you're going to pay higher taxes when you put money into your Roth. So basically, the idea is as your income is lower and you're in the early years, it's better to put it as tax-free, so it grows tax-free your investment. So when you are making more money later on, you don't have to pay a higher tax bracket. Any questions there? I know that was a little bit wordy there, but I want to make sure that there's no confusion.
We can wait for questions on this, but I do have a question that came in from a little back on high yield savings account. Someone
Okay,
asked that if opening a high yield savings account will lower their credit score or if it goes on their credit report. It's a two-part question. That's part one. And then the second part is if they have to pay taxes.
great question. So one, for the first question, it does not impact your credit score. It's a savings account. It doesn't impact your credit score, or it's not dependent on your credit report. So that's a no. It does not impact it. Your second question, do you have to pay taxes? And that is a yes. So you pay taxes on the interest that is earned on your balance. So it's only paid, it's not paid as an income, it's paid as what's called a capital gain. Capital gain have a different tax bracket, and then we can talk about that in more details, but it's basically lower. So if you make $10 on interest, then you will pay like $1 on a capital gain. That's 15%. Any additional question to that, or any if you want me to talk a little bit more?
Oh, sorry. Yes, we have one more question that came
Mhm.
in, which is, well, are we basically gambling that we will make more money as an investment between now and retirement than the amount that we will pay in taxes later? Let me see. Let me read this. It seems like at retirement, the tax rate would be a lot higher because everything goes up in life. So I think basically it's just saying is, are we making a gamble that our tax rate will be higher later on in life versus now? Is that a guarantee considering the fact that expenses go up, over time?
So I think I'm going to respond it in a way that I think what the question is. So um, I'm assuming the question is specific to the Roth versus the
Yes, yes.
tradition. Okay.
It's
Okay.
like about the pre and post tax, yeah.
Okay. So I guess I will not use the word gamble. I will use, okay, if let's say you're starting now, let's say you are in you're 25 and you have an entry level job wherever you are now, and you're making $60,000 or $40,000. But the goal that you have is, okay, I am going to get promoted. I am going to maybe get my master's degree, and I'm going to have a higher income. When you have your higher income, at that point, since you're going to pay more taxes, you might want to do a pre-tax contribution. So you are reducing your taxable income. because now you're in a different tax bracket or in a higher tax bracket. However, if you have a high income now and you say, okay, maybe in 10 years, I'm going to work part-time, my income is going to go down, then you can do a Roth contribution when your income goes down. So I guess what I'm trying to say is it more beneficial to you now to reduce your taxable income because you're in a higher tax bracket, rather than I'm in a lower tax bracket now, I'm going to do a Roth contribution, which is an after tax. I'm going to let it grow tax free. But as my income goes higher, I may go back to doing a pre-tax contribution.
Nice.
So does that make sense?
Yes, they said thank you.
Okay.
Very helpful. Yep.
Oh, perfect. So, but let's say, sorry,
Sorry,
go ahead.
please continue. Continue.
No. So I want to add something else. So let's say you're in a high tax income now, but then you think, okay, when I retire, my income is going to go down because your income is only going to be driven by the amount of money that you're taking out of your investment account or your Social Security. And that's the only money that you're going to report as income. So you pay tax. Your tax bracket most likely will go down during retirement.
That was
So,
great.
okay, perfect.
Thank you.
Great question. Thank you.
There are a few more if you have time, or did you want to wait?
Is it related to pre-tax or after tax?
Yes. So one is in regards to the difference between withdrawing before 63, in a pre-tax or after-tax account.
Yes, great question. So I'm going to hold on to that one because I actually have a couple of slides that I can explain that. So I think any other questions related outside of that pre-tax and after-tax withdrawal?
Yes, someone asked, would you recommend a traditional IRA versus a Roth IRA if your income is 150K annually or more?
So an option, this could be if you're paying taxes at the end of the year and you want to reduce your taxable income, doing a traditional IRA or 401k will help you reduce that taxable income. If you think that your income is gonna go higher than what it is now, then you can actually no, you'll have to do a traditional because there's an income threshold in the Roth contribution, and
Oh,
that's a
yes.
specific. Yes, we'll go over that in a few slides from now.
Thank you.
Yeah, no, thank you for the question. I'm really enjoying the questions, so please keep putting them in the slide. So let me go through the next couple of slides, and maybe it may ask additional questions that you have. Okay. So another example of your 401k. Let's say your employee, you have a salary of $50,000. You contribute 5,000. Your employer matches 100% of the 5%. That means that you're contributing to $5,000 a year. I wanted to show this graph so you can see the difference, and I know that visual really tells a story, and sometimes we don't take advantage of the 401k matching contributions that employers provide, but taking advantage of those contributions, those matching contributions actually generate a large sum of money over time. So in this case, in 5 years, the employee contributed $67,000, but the company matched $54,000 of that. In 10 years, you contributed $112,000 and your company contributed $90,000. So now you have $200,000. So it definitely adds up and it grows over time. So taking advantage of the 401k and an employer, especially the ones that have matching contributions, it's definitely something that I would recommend that you do. It doesn't have to be a lot of money. You can start with $50 a month and then increase it over time. But as long as you start, that's the key. Okay. So let me talk about retirement, a traditional IRA and then a Roth IRA, and then we're going to talk about those before and after taxes. So the traditional IRA is an individual retirement account. So if you don't have a 401k through your employer, you can open one under your name. It's not tied to your employer. So if you leave your employer tomorrow, that retirement account is yours wherever you go. Contributions may be deductible, tax deductible, and I'll share in a little couple of slides what that means. Again, it growth tax deferred, withdrawal taxed as income. So when you take the money out, you pay taxes then, depending on which tax bracket you are when you start taking the money out during retirement. And again, it's a good option if you don't have access to a 401k or a 403b or a 457 if you're a firefighter. And then we have the Roth IRA, which is the same as the Roth 401k. It's after-tax retirement savings account. It's contributed with money made after taxes. It grows tax-free. You can take the money out at any time without any kinds of penalty. So the money that you contribute into your Roth IRA, you can take it out anytime. You can make qualified contributions out of the gain of the Roth IRA after 59 and a half, or if you had at least the account open for 5 years. So, and this goes back to the question that we were having before. So you want to, there is an income phase out amount. If you're a single tax filer and you make more than $167,000, you are not eligible to contribute into a Roth IRA or make any Roth contributions. If you're married filing jointly, then that phases out at $250,000. And this is as of 2025. It may go up next year or it may go down next year eventually, but those are the income phase out. So for the participant that had the question, the $150,000, if you want to reduce your taxable income today, you can do pre-tax. If you're okay paying taxes today on the what you contributed into your Roth, then do the Roth now, especially if your income is going to go higher in the next few years. Then taking advantage of the Roth contribution now may be something that you want to do. Again, I don't want to give specific recommendations. I don't know the situation, but certainly you can schedule one-on-one coaching session and we can talk about more specific about the situation when it comes to making the Roth or traditional contribution now. So here are the two examples. So if you withdraw, so let's say you make a Roth contribution and you take and let's say you have $42,000 in your account and you take $10,000 out of your account, that is coming out of the contribution. So there's no taxes, there's no penalty. If let's say you have $25,000 and you took $25,000 out of your account, then you are taxed on the $5,000 and you also pay a penalty on the $5,000. So I don't know if that addresses the previous question from one of the participants in regards to withdrawing tax or pre-tax. So any question there or any points of clarification?
Yes, we do have a question coming in.
Mm-hmm.
So what happens if you are contributing to a Roth IRA for some years and then your income exceeds the top or the limit? Do you have to wait until you turn 59 or can you take it out beforehand?
You can take it out beforehand or you can just contribute to a traditional IRA. So then you can have two balances or two accounts. You can have a Roth balance, a Roth account, and then you can have a traditional account or a pre-tax account.
If follow up, if you take money before 59, would you pay taxes on it from the Roth IRA?
No, Again, if there are exceptions. So if you are taking more than what you've contributed, if you take it out before you're 59, there may be some penalties associated with that.
Yes. Yes, I think so. I think
Yeah,
if you can take out what you've put in, but money that you've earned, like capital gains, I think you get penalized.
before 59, yes.
Yes, before 59. Yep.
Yes, yes.
Then we have,
Any other
yeah, sorry, I
follow-up?
have another one
No,
coming.
no, that's okay.
If you contribute weekly to a Roth IRA and then exceed the limit, um, like what if you contribute weekly to the Roth IRA and then you exceed the limit? So I think they're asking like what happens if that's the case. And this is for
You
someone that's under 30.
Okay, you can take money out before the end of the year, because as long as you have so it's $7,000. As long as you have $7,000 for the year, let's say 2025, you're fine, because it matters when you're filing taxes. So let's say we are in October and you, instead of depositing 7,000, now you have $7,500. You can take the $500 out and put it in your savings account till the following year.
Awesome.
So yeah, you
And
can always
I
take money out.
and I think the cool thing about a Roth, and Samantha, correct me if I'm wrong, is you can contribute money up until April of the following year, right? So you don't have just 12 months. You have like 15 months to put in the max before the tax year ends, right? Something like that.
Correct. Yes. Yes. Good. That's a good point. So it's not like you have to do it every month. You can do it a lump sum. It could be right before you file your taxes. Yep.
And then one more question. If you are contributing to a Roth IRA and you lose your job, are you obligated to put money or get a fee for not moving your account for some time?
Nope. You don't. You are not required to put money in, and you're not going to get charged a fee for not putting any money in. So that's a great question. So let's say you also have a 401k. If you leave your employer, you don't have to take your 401k account with you. You can let it sit there until you're ready to roll it over into another account. And you're not gonna pay a fee for doing that. Great question.
Okay, that is it on questions for now.
Great. Thank you for all the questions. I'm really enjoying that. Okay, so now I want to put it all together. You have your 401k and you have your traditional IRA, which is a pre-tax, and then your Roth IRA, which is the after-tax. Who can open the 401k? That's through your employer. So when you um, have a job through a company, they'll open, if you sign up, they'll have a 401k for you. You can start contributing to your payroll cycle. Um, if you don't have access to a 401k, you can open a traditional IRA and a Roth. You can have both if you want, by the way. You can have a 401k through your employer, and then separately, you can have your own traditional IRA or Roth IRA on your own. You don't need to have one or the other. You can have two of each. Um, these are the limits to contribute in a 401k is $23,000. If you're over 50, you have up to $30,500 that you can contribute on an annual basis. For the traditional and the Roth are the same, it's $7,000 each. If you're over 50, it's $8,000. Your tax treatment for your 401k, we're talking about pre-tax contribution. It lowers your taxable income, meaning you pay less taxes today, and then you pay taxes when you take the funds out. In a traditional IRA, it's the same thing. It's a pre-tax taxes. There could be some kind of you can deduct some of that contribution. And the Roth IRA is after tax. There's no deduction, but you don't pay taxes and the growth is tax free. You can take it out at any time. Tax treatment here, tax as ordinary income when you take the money out, meaning, so if you are in the 22%, it's charging 22% when you take money out. In the Roth, and contributions are tax-free. Employer match, yes, in 401k. Your IRA, there's no employer match because it's not through your employer. And then there are penalty rules, the same thing for the 401k penalty if the money is taken out before 59 and a half. There are some exemptions there, like there's loss of life or there's other benefits that there's some kind of emergency that where you need the money. I think could be also a provision there on the employer side where you can take some of your funds out to address some personal needs. Again, we can go more in detail on a one-on-one basis. And penalty in your traditional IRA if you take them before 59 and a half with some exceptions. And then the Roth IRA, again, earnings, any contributions that you've made into the account can be drawn at any time. If you start taking the earnings, then you can pay some penalties. So again, lastly, what's best for 401k will be best for the ones that have an employer, especially the ones that provide the contribution match. The traditional IRA is for those that do not have a 401k or 403b or all the kind of employer sponsored account. And then the Roth IRA could be for younger earners that are expecting to increase their income later on in the years. So again, you'll receive something like this via email as a follow-up to this webinar. Okay, so we have 10 minutes. So I want to talk about, okay, if you have a child, if you have a grandchild, okay, what are the things that you can do to start saving for their future? So there's 3 things that you can do just as a high level. You can open a 529 if that is something that could benefit if the child goes to a higher education. It can also be for any private schools between K and 12. Custodial accounts are savings account where the custodian has access to it, but it's in the name of the child. And then it could be a simple option as having a savings account under the child's name, or you can buy like treasury bonds under your child's name, or just simply just send money aside in a particular account just for buying books or buying a computer or anything that the child needs. And I know we talked about this during my first presentation, but the best thing that we can do for kids is to teach them how to save and have healthy financial habits. Okay, what's a 529? It's a education-focused savings account. You can start at any time. If you have a child that was born tomorrow, you can start a 529 today. So it's tax advantaged. It grows tax-free when it's used for education. If you use the funds for something else other than education, there's a penalty allocated to that. The funds can cover tuition, fees, room, board, and it's not owned by the parent or the grandparent, not the child. So the child is not able to take the money out, and it can be transferred from child to another family member. So let's say you have a child that decided not to go to higher education, then that can be transferred to someone else in the family. There's a new rule that in 2024, which is a good option, that any unused funds can be rolled into a Roth IRA for the beneficiary could be your child. So let's say, for example, there's $20,000 in the 529 fund, but only 10,000 was used. The 10,000 can be rolled over into a Roth IRA. There's a cap. So that's at $35,000 lifetime cap. And the the rule is also that the account should be open for 15 years. Then there's other custodial accounts. These are not usually very talked about or popular, but there are options. The UGMA is the Uniform Gift to Minors Act account. And then this UTMA, which is the Uniform Transfer to Minors Act account. So they're basically accounts that are held under the child's name, but are managed by an adult custodian. So let's use me as an example. So if I have a child, I have a custodial account under my child's name, but I manage the account until until they become 18 or 21. You can set those limits and those terms when you open the account. It can be flexible. It does not have to be specifically for education. It could be, I want to start saving money for my child. So when my child is older, I want my child to be able to buy a car or a house. There's no contribution limits, but some may have tax implications. And I'll give you a little bit of information on that shortly. And again, the child becomes gains full control of the account when it becomes 18 or 21, depending how you set the terms of the account. Okay, this is the difference between those two accounts. You can, in the UGMA account, you can have cash, stocks, bonds, insurance policies in that account. It's allowed to include those accounts. In the UTMA, you can include real estate properties or royalties. So there's more flexibility on what financial assets you can have in there. The UGMA is available in all states. And then the UTMA, it's not allowed in all of the states, so it's not universal. There's some exceptions. The ownership belongs to the child. Again, they don't have full ownership until they become 18 or 21, depending on how you set those term limits. And then it can be used for anything that the child needs before age 18 or after. There is this is a tax implication. And again, I don't want to go into too much in the taxes because there's some nuances with taxes, but I do want to include it so everyone is aware that there's what's called a kiddie tax. So any unearned income for the child age or 19, there is a tax associated with it. And the reason why this was implemented is to prevent parents from shifting investments into a child's name to avoid taxes. So again, if you have specific questions regarding that, email me or we can have a one-on-one. But definitely, if you have any specific questions when it comes to taxes, make sure that you ask your tax advisor, or if you have a tax professional that you work with. Okay, question. Manny just started working and has $200 a month to save. What would you recommend? A, for Manny to save it towards an emergency fund, put it in a Roth IRA, or open a 529 for a child? I'm curious to see what you will recommend.
Few answers coming in. B, A, B, A. So we have a lot of A's and B's.
Good. Those are good options. Definitely. So having an emergency fund definitely is good for Manny to do. But since Manny just started working, so we'll assume that Manny is in the younger years. So putting money into a Roth IRA will also serve a purpose, that if he needs to take the money out before he retires, he can always take some of the contribution money out. So that is definitely a good option. So yeah, those two are great answers. I will say start with your emergency fund in case Manny needs funds tomorrow for unexpected expenses. And then a Roth once Manny has an emergency fund established, but for at least $1,000, because the Roth do take a little longer to take money out because you have to put the request in. So it may take a few days for you to get the funds. So definitely having the emergency fund first and then a Roth, it's a good option. Thank you for that answer. Okay, lastly, so I wanted to put this together. How do we put it all together? So if you are in your 20s and 30s, and again, this is not set in stone. I do agree and believe that we all go through different stages at different ages of our lives. But this is just an example that if you are in between your 20s and your 30s, you're starting your emergency fund, you're saving toward your employer-sponsored 401k or 403b, and you are taking advantage of your employer contribution. You have automatic savings to your short emergency fund and your retirement account. And if you have short-term goals or those goals between 1 to 5 years, putting money in this is high yield savings account where you can earn a higher interest. It will be advisable. That way you are earning a higher interest while you leave your money sitting in the account for months or years. And then let's say you are in stage number 2, you build a momentum, you already have your foundation, you're saving a higher of your income toward your retirement. Maybe you have children or you have grandchildren, you can open a 529 or a custodial account. You can invest in a brokerage account. And again, we'll go over next week of what that means. But it's an investment account outside of a retirement account, basically, where you can also do wealth building strategies. And then if you're after 50, take advantage of catch-up contributions, meaning let's say you have an IRA, 7,000 is the limit, but if you're over 50, you can contribute an extra $1,000 into that account. So that is all I had for today. And I thank everyone for your questions and your comments and for attending today's webinar. Any last minute questions or comments, Jennifer?
No, thank you so much. You have some thank yous here, but overall, no questions as of now.
Great, thank you.
Nice. Yeah, thank you. We have some thank yous from everybody coming in. Hopefully you can see those. And if you guys do have any final, oh, sorry, we do have one question here. Can parents open a Roth IRA for children, for their children?
Yeah, you can actually open a custodial, so it'll be under your name, and you can have a beneficiary for your child. Yes. But the thing with that is that they need to have earned income to have a Roth IRA. So let's say you have a 15-year-old that if you have a business that works with you in your business, then you can contribute to the Roth IRA. Again, please schedule one-on-one with me if you have any specific questions related to your situation.
And someone asked, you can do that in addition to your own Roth IRA? And I'm assuming the answer to that is yes, like opening your child in addition to yours.
Correct. And again, the caveat here is that there needs to be some earned income. So if your child is not earning income, then I would recommend a custodial account or a savings account where the child is the beneficiary.
Ooh, amazing. Someone said, keep the workshops coming. And Jessica, we got you for the next 6 weeks. We're going to keep them coming, no more breaks. And let me tell you a little bit more about what we have coming up next week. If you see my screen, we have investing for beginners. This is a very popular topic. We would love to see you all there and share it with some friends, some family members who you think could also use this information. We are super excited about all of our workshops in this series, so please continue to come back and get the wealth of information. You guys can all see my screen, right? Yes. Okay.
Yes.
And I will drop the links in the chat, and you'll also receive some links in the follow-up email as well. And as mentioned, and we will continue to mention it, you can you can sign up for coaching with Samantha Morales at any well during her availability on her Calendly. It looks like October is booked. So coaching sessions are open all of November and just a tad bit of December. So don't miss your chance and sign up. Please, we'd love to see you there. And lastly, if you want to dive in a little bit deeper, we have a platform called Enrich, completely free for Massachusetts residents, where you can go read articles, take mini courses, blog posts, watch other webinars on any topic of interest that you may have. So definitely check out that platform. So yes, if you work with an organization, you can give your client the link. I am dropping it in the chat right now. And as always, you can always email me with any questions you may have. I am always responsive to any and all questions and emails. And the one-on-one sessions are free for up to an hour. And this is not for promotional purposes. You'll have your one session and we will leave you alone. We will not bug you or anything like that. No commitment, just your one session to help you get your finances together. And it's completely anonymous. And Samantha honors the confidentiality between client and advisor. So we do not receive any information. So, definitely no ties and no harm to getting that coaching session done. Well, thank you everyone so much, and we'll catch you next week. Bye.
Thank you. Bye.